What's happening, guys? I hope you're doing well. Hey, there's been some big news, and I wanted to kind of unpack it for you because we're starting to see it kind of blasted all over online, on social media, and it's that the loan limits have changed. And honestly, most people don't know what that actually means. So I figured I'd take a second and record a video to explain to you exactly what that means, why it benefits you, and why it's kind of a good thing for the market. So let's dive in and take a look. First and foremost, we've got to understand what these loan limits are attached to. So today, we're going to look at conventional loans. That's where the bulk of these adjustments have been made. There are new loan limits for FHA and for VA, and we'll touch on those in a different video because they're really totally separate. But today we're looking at just regular old conventional loans. So whether you're doing a conventional ARM, a 30-year fixed, 15, a 20, doesn't matter. A lot of these loans that are conventionally based, meaning that they're going to eventually be sold or backed by Fannie Mae or Freddie Mac, that's what this loan adjustment or the loan amount adjustment is going to impact. Okay. The idea behind it is that as the house prices kind of increase in value over time, the purchase prices start to escalate, as we've seen over the last decade or so. It would move people out of the need to get jumbo financing. See, if the county loan limit was say 400 grand, and you wanted to finance a house that was 800,000, put 200 grand down, you got a $600,000 loan, you'd have to get a jumbo loan at that point. And jumbo financing is just a totally different animal. Jumbo financing a lot of times needs higher reserves, maybe a little bit less flexible on the credit score. It may want a little bit lower, more conservative debt to income ratios. It doesn't have as wide of a pool to deliver to. It's usually offered by the bank itself. It's backed up by that specific bank, instead of backing it on a big provider like Fannie Mae or Freddie Mac, where these loans eventually are sourced. So conventional financing in general is going to be a little bit more flexible. And if you want to stay away from the jumbo, if you're, say, a first-time buyer, you want to put maybe 3% down, jumbo might ask for 5 or 10% instead. So a little bit more flexibility there from a product selection standpoint. Here's what they look like last year, and here's what they are today. So if we kind of take a look at the screen, we've got 647,200 for last year, and that's for a one-unit home. So most of your single families, most of your condos are going to kind of fit into that bucket. As long as your loan amount, this isn't the sales price, this is the loan amount. As long as your loan amount fits 647,200, you were good to go. You kind of fell into that range. It didn't really matter, and this kind of covers the entire nation, basically. That number now is 726,200. So think about somebody here in Los Angeles, California, and they're buying a house that is, 1.5 million. They're trying to put 5% down. Well, they're probably not going to fit into this bucket. There's a whole separate bucket for them called the high balance loan, and I'll talk about that here in a second. But somebody that's, maybe they're in, I don't know, let's name a state, Iowa or Alabama or Ohio. Most of the sales are going to fall into this, where the loan amount is kind of falling underneath that 726,200. So it really kind of opens up the financing options for a lot of those people. And you can see below there's where it has the units 2, 3, and 4. You get a little bit of a bump for each one of the units. So if you're buying a 2-unit, was 824 or 828 700, it's now 929 800. 3-unit got an increase, 4-unit got an increase. So in fact, a 4-unit, using the just normal conventional guidelines, not going into high balance or anything like that, 1.396 800. That's pretty good. Big jump up from what it was last year. And over on the right, you've got Alaska and Hawaii, totally separate set of rules. They get their own special treatment, being the 49th and 50th state for some reason. So not too many people that I work with that are buying or trading real estate in Alaska or Hawaii. So we'll kind of skip over that one for right now. High balance. This is for anybody that exceeds the new loan limit. So Los Angeles County happens to be one of these high balance loan areas. And so if we kind of look here, you can notice that the previous slide showed the county loan limit was 726,200. Well, for a high balance loan, it needs to be at least 726,201, all the way up to 1,089,300. So 1,089,300 would still allow you to use Fannie Mae and Freddie Mac's guidelines, but there's going to be some high balance adjustments on that loan. So they don't make you go jumbo. They'll still offer normal conventional financing for you, but there's a couple of little adjustments that are made because you're kind of in this other window called a high balance window. So let's take a look at what that looks like. So here is what those adjustments are. This is a snapshot of the table right from Fannie Mae's guide set. And so if we take a look here and you're in a high balance loan, let's say you're doing 3% down and you're purchasing the home, you would have a 1% adjustment. See this right here where it's showing this is a loan to value of 97. So you're putting 3% down. It's a 1% adjustment. That's not to your interest rate, that's to the cost. So your choices at that point are to try to find a rate that's offering a little bit more premium. So maybe go up a little in the rate stack and it can bury that cost, or you could just simply pay that cost at closing. Your choice, your lender will kind of help figure that out for you. But that's the adjustment on high balance. So that same person that was buying a home and their loan amount was going to be $726,200 would not have this fee adjustment. So their fees are going to be a little higher if they go over that, and or the rate might be a little bit higher, or a blend of the two, whichever you kind of choose. And you can kind of take a look here. You got all these cash out adjustments. You got ARM adjustments, second home, multiple unit adjustments, condo adjustments, et cetera. And these are all specific to high balance. It's what makes them somewhat unique. Here's kind of a snapshot real quick of some popular counties in California. So you got up here, you got Kern County. So Kern County, conventional financing, 726,200, no problem. Los Angeles County, just like we talked about, that 1,089,300. And if we kind of look in here, you got some oddballs like Monterey County for some reason is 915,400. Who comes up with these numbers? I have no idea, but 915,400 is Monterey County. Now Napa wine country is 1,017,750. How they got that number, literally no clue, because these just seem so incredibly random when you really look at them and break them down. So you always got to double check your county to see if you kind of fit. If you're talking to a lender who maybe just doesn't understand the county, they may think that it's 726,200 when in fact you might be buying a house in Placer County and it's 763,600. So you have a little bit more room there. You don't have to go with a high balance loan and pay those extra costs. You can actually take advantage of kind of the more aggressive pool of loans on the conventional financing. So at any rate, any of these counties that you need to look up, you can always reach out to somebody like us. We can run them for you. We can kind of tell you where they fit. The columns that you see over on the side here, this one, and this one, this is for 2-unit, 3-unit, and 4-unit properties. Again, those get those slight adjustments and bumps over time as well. So it's really important to kind of know, are you looking for a single family? Are you looking for a duplex? Are you looking for a triplex? What's the purpose? What kind of house is it? So we can kind of price these things accordingly for you. All right, guys, any questions, anything that you need, let me know. There's a QR code right there. You can snap it with your phone, get in contact with us, and be happy to answer things for you. And we look forward to talking to you on the next call. Thanks again.